At the beginning of my trading journey, I would watch profitable traders make money consistently and grow small trading accounts, thinking it was all luck. As an engineer, I was disappointed to find out that it was just simple math that I needed to understand before seeing positive results. In this video, I'll be sharing 3 simple math formulas that are behind trading success. What is the challenge here? So you have a green streak, you have won multiple trades, 5 trades, 10 trades in a row, they're all green. But 1 or 2 red trades just wipes out your gains. Number 2, you're watching profitable small account challenges and they just feel impossible. What do you mean someone took $3,000 and they were able to make 50K plus in a year, in like however long, but they were profitable? And number 3 is a painful one. But don't worry, by the time you watch this full video and you go through the 3 formulas I'm going to be showing you, you understand why this happens to you. Number 3 is you follow your favorite trader into every trade, but at the end of the month, that trader is profitable and you're not. You're wondering, why is this happening to me? Don't worry. Once you watch this video, understand what is going on with you, and I'm sure you would probably be able to fix it if you put this video to use. So you can take any strategy, whether it's supply and demand, ICT, order flow, break and retest, trend lines, whatever it is. All these strategies work, but they would only work for you if you understand the math I'm about to go over. There are 3 mathematical formulas. Formulas 1, 2, and 3 all go together for you to see the desired trading success that you want. And formula 3 is the most important formula in trading. A lot of traders struggle with it. I used to struggle with it. And by the time I go through all 3 of them and you go through your trades and you see what I am trying to convey in this video, you'll be like, oh wow, now I know what I'm going to start fixing. So formula number 1 is expectancy. This tells you the truth about your entire trading system and how you are trading it. What is the formula? The formula is simply your win rate times your average win minus your loss rate times your average loss. Now, for example, let's assume this trader has a 50% win rate, which means that their loss rate is also 50%, and the average profit is $500, and the average loss is $250. On average, this is at least 20 trades. You have to take at least 20 trades for you to see what's going on. Now, what is the expectancy using this formula above? The expectancy would be 125. It means that on average, this trader has a positive expectancy. It means that they are profitable, and after 20 trades, they have 2,500 profit. After 200 trades, $25,000 in profit. Significant amount of money, because they understand that they don't have to have a high win rate. They just need to have a high profit margin. When they win, their winners have to be big. It does not matter if you have a 40% win rate, you will still be profitable. What you want to avoid is this. You want to avoid a negative expectancy, which is the opposite of what I showed you, where your average loss is $500 because you don't know how to keep your losing trade small, and your average winners are $250. You'd have a negative expectancy of minus 125, and that $5,000 account, for example, if you have a $5,000 account, it will take you 40 trades to blow up your account. You might not even make it to 40. So this is one formula that you need to understand and make sure it is positive over at least minimum 20 trades, 50 trades. Like, the best scenario is 100 trades for you to know that, okay, this strategy works, because you would not be worried about a 5 trade losing streak. If you lose 5 trades, you're fine, because okay, I know at the end of the day my expectancy for this trading strategy is positive, assuming I follow the rules to the T. Formula number 2 is risk to reward. Most people tend to focus so much on risk to reward on the per trade basis, but it's good to look at it over a number of trades. So after a month, after 2 months, look at it. How much were you risking versus how much were you gaining? Example, if you have a 1:1 risk to reward, a 50% win rate, you will be most likely break even. But if you make 3 changes, such as cutting your losers faster, fixing your entry so you don't enter too late on those winning trades, and you hold those winning trades a little longer, you can then increase that risk to reward to 1:2 while still keeping your 50% win rate, and you would be in profit. The difference is your risk to reward over a number of trades, not just one trade, 20 trades, 30 trades, 40 trades. See how that looks, and you compare it to your expectancy as well, and then you're able to be like, okay, now I'm onto something. Moving on to Formula 3, because Formula 3 is where a lot of people still mess up. Formula number 3 is position size. It's the most important formula. So you could get risk, you could get holding your winners, all of that. But if your position size is not managed accurately, you get too confident, you start to increase your size relative to your account, and then you take that one loss that just destroys or takes a dent in your trading capital, and it's hard to recover both mentally and from a capital perspective. So what is position size? You're just calculating your account balance times your percentage risk divided by your stop distance per unit, per share, per contract. Depends on what you're trading. Now, if you have a $5,000 account balance and your risk per trade is 2% of your account, most people tell you risk 1% of your account or 2% of your account. 1% is difficult for small accounts because it can be, for example, on a $3,000 account, 1% is $30. What can you trade? Really? What can you trade with $30? Human greed would not even let you see it as much, because there are not a lot of assets that you can trade with $30. Maybe Forex, but I do not trade Forex. Now, with that being said, you have a $5,000 account, you're risking 2% of your account. That's $100 per trade. Now we have something we're working with. If you're risking $100 per trade and you're looking to make $200 per trade, you can trade futures, micros, ES, MNQ, max 2 contracts. And depending on your strategy, you can trade anywhere from 1 to 2 contracts. If you're just starting your trading journey, I recommend just start with 1. I'll give yourself a chance to learn, understand how you feel risking real money, because it's not easy. If you're trading options, I would recommend SPY, QQQ, IWM, NVIDIA, Apple, and max 2 contracts of the weekly options. If you want me to make a video explaining options, showing you how to trade options, let me know in the comments and I would make that video. I need to see demand first before I spend time to make that video. Even futures as well. I need to see demand before I spend time to make that video. Remember, your position size is how much am I willing to lose, and everything starts with your position size. If you're able to manage your position size so that you have more chances to allow expectancy play out, to allow those 20 trades play out where you're positive, to allow those 200 trades play out so that you're positive, and your desired reality will look something like this, where you have that steady growth. And if you have a $5,000 account, you can grow your account by 2.7 times, and you have 13,500 after 100 trades. In my opinion, it's much better than having a roller coaster of blown accounts, boom and bust cycles. If you can stick to the math, understand that you need to have all these 3 things in your favor. If not, it will be hard, extremely hard to be profitable. Win rate does not matter. It's your risk, it's your position size that matters the most. Thank you so much for watching this video. I will see you on the next one.